excellent. I'd love to open it up for questions. And Brittany's coming over to you.
Hi, I'm Gabrielle King-Morse from You Aspire. If there was a benefit available, and I've seen now organizations like PwC and Starbucks offering debt repayment and matching, what would you recommend to a young, let's say someone in their 20s, if they have the opportunity from an employer to either match payback on their student loan or match retirement?
That's a good question.
I think it probably depends on, it really depends on the interest rate you're paying on that student debt. If it's debt at below 4 or 3% interest, then it may make sense to take the match on the retirement, or to prioritize that. If it's interest in excess of 5 or 6%, then it probably makes sense to pay down the debt first. And so it probably depends whether you got that loan from the government or from a private lender, and then what your credit was when you got it from the private lender. All those things I think would come into play. But it's really a rate of return comparison, I think, at that point. And for a lot of people, I bet it's safe for retirement as long as those loans were kind of got an interest rate. That I know less about.
So the thing is this, is that right now, 401k is pre-tax money, tuition reimbursement is pre-tax money, but student loan debt is actually post-tax to the employer, and that's actually preventing a lot of employers from doing that, right? And I mean, post-tax to the employee within that, so their employees' tax brackets can go up across that. But going back to your original question around what is a better way, as clear, there's no answer, but what we have found out is there's the right answer, which is the financial calculations and things like that, but there's the emotional answer, which is a lot of people think about this as not parallel processes, but as like serial processes, which are like, I have to pay down my student loan debt first before I can even start contributing towards retirement or other things, because it's like an emotional hurdle that I just want to get over with. So any kind of excess payments that I have, I'm just going to pay down my student loan debt, and if the employer can help me, that's great across that.
Another question, yes.
Hey guys, is this on?
Yep.
Yeah. I'm Tony Aguilar with Student Loan Genius. Through all the research you guys have done, have you seen with your research, do you know how long the effect of student loans is going to have on the retirement side of things, or the ability for millennials to purchase homes? Like through your research, do you see how long that lasting effect is going to take place?
Sure. So from the joint study that we did with ASA, both the current homeowners who can't move up into a home that's more appropriate for them, or perhaps even downsize to a home that's more appropriate, and for the non-homeowners who are living with mom and dad or renting, they both said 5 years, a median of 5 years would be the delay. Among our successful homebuyer population, if you segment it out, it depends on if they're a single person. If they're an unmarried couple, it gets a little longer too, because they're typically younger. But typically it's 3 years, but it could grow dependent on the amount of debt.
Yes.
Hi, I'm Chris Robbins from UMass Lowell. I have a question about the employer paying back the loans. How exactly does that work? I know it's post-tax dollars, but do you just pay right to their lender, whoever that may be, or do you actually give the money to the employee?
Yeah, so how it works is that you actually pay down the servicers. So the money goes directly to the servicers, not to the employees themselves. So they see that as a added income on their paycheck, but they never get to see that money because that is on their behalf sent directly towards the servicers, towards a particular loan that they're paying down.
Okay, thank you.
Any other questions? Yes, there's there too. So we'll have this gentleman, and then we have a woman who's in the back.
I wonder if you could speak a little bit about the impact on individuals when they start a family. Is there a later trend to that? How's that related to student debt or to purchasing? So changes in the age at which people get married, if they do, that type of thing. as well as childbearing. Could you talk a little bit about the impact that student debt may have on those decisions?
Yeah.
Sure. I think a couple of us have answers on that. I will say on the first-time homebuyer age, since we've been collecting this since 1981, there's actually a very narrow range that first-time homebuyers enter the market. They typically enter between 28 and 32. So they need to be old enough that they feel like they want to stay in one spot and to save up that down payment. But they do actually stay under that 32-year-old range. And it doesn't seem to have an impact on whether they have children or whether they're married. We actually see a huge rise in first-time homebuyers who are not married. Either they're an unmarried couple or they're a single in the market. So we do see this going on as well, that dynamic. There's been a lot of arguments that are saying that, well, people think that psychologically you need to be married and you need to have kids on the way, or at least be thinking about it. And that could be back of mind, but it does seem like people want the financial stability and ability to grow within homeownership, despite the constraints of marriage, perhaps. So willing to actually purchase a home on their own.
Yes, there's a woman in the back there.
So if an employer is paying back the student loans and it shows up on their W-2, if they're an income-based repayment program or a contingency plan, does that then raise their income and then would raise their payments?
Yeah, so that's exactly the problem, which is it can actually raise your income across that.
Yes, another question. We have a gentleman who's right in the aisle there.
With the new demographic of home buyers, the first-time home buyers being out there, do you see equity in homes being more of a value to them in order to pay off that student loan debt? And do you see more equity products being made due to that?
That is a very good question. So this is something that's definitely hotly debated among our members too. I did see the release this morning that I'm forgetting which lender and SoFi. Yeah, I believe. Is looking at refinancing Fannie and SoFi your home loans to actually pay down your student loan debt. I don't have much experience besides reading that one article as I boarded the plane, so I'm not entirely sure if this is a good idea or not a good idea. I think that similar to your answer, if it's a lower interest rate, perhaps that is a good idea. But I know that there's the toss-up of wanting equity in your home as well.
One thing I was going to say about that is that as far as thinking about retirement goes, refinancing the house to the extent it resets the clock is an interesting thing for retirement. It used to be no one entered retirement with a mortgage still being paid. We've seen that really drastically increase over the last 5 or 10 years, and it's really unclear if that's a permanent thing because people are buying their homes later, or if it's the housing boom led people to refi or to take out equity at that point, and whether it will go away. But things like this, it can be good, but it also can kind of push that mortgage payment back into the time when income goes down a lot. So just worth thinking about that too.
Excellent. Yes, ma'am, down here, you had a question.
So it was really a follow-up to the previous question that was asked in your answer around wouldn't it increase or take somebody who's in a income-based repayment and push it up? And your immediate answer was, yeah, that could happen. But I would argue and ask you to comment on the fact that that's not a bad thing. Many income-based repayment plans actually end up with payments that are below the interest only and cause negative amortization, where borrowers end up actually owing more. So if they're in a situation that actually pushes them out of an income-based repayment plan and actually puts them in a situation where they're paying down the principal, that's a good thing, right?
Yeah, I mean, you can look at it two ways, right? One is you could argue that income-based, some of the income-based repayment programs are just kicking the can down the road. So, which is like, it's good for the short term, but not good for the long term. But the other interesting point is that after 20 years, you're eligible for forgiveness on these plans. So.
But I would argue there's nobody out there who is really trying to move up in a career that wants to stay at a low income for 20 years, right? So
right.
that's for a particular population, right?
Absolutely, right? So the thing is, I mean, these plans are out in the market, and the thing is, all of these plans were put in place as maybe a stopgap is the wrong word to put in there, but without thinking about all the repercussions across this, right? So it will be interesting to see what the repercussions are in the years to come, right? So I'll give you another example, which is this interesting program, which is the Public Service Loan Forgiveness Program, right? That some people might be aware of. And 2017 will be the first year when that forgiveness is actually valid for the first wave of people. And it will be interesting to see what kind of repercussions that will have. And the other interesting thing I would bring up is that the accounting on the government level for all of these programs is totally opaque. Like, I don't think anybody has an idea about what it is going to do to Treasury across all of these payments across these. So it's a good point, which is like, there are all these options in the market, and the question is, no, all the repercussions haven't been thought about within this.
Do you feel like colleges and universities are adequately preparing or doing enough to educate their students as they graduate and go on, and even watching the video, and even some of the folks that you talk about with Fidelity who don't really know their options, they don't know how they should repay, and these different measures that they're weighing?
So I think this is the interesting thing is, technically every person who has a student debt is supposed to go through exit counseling, right? So they signed some paper that they understand their student loans, how it works, and how much they have. But you ask an average borrower, how much student loans do you have, at what interest rate, and when will you pay them off? They will not be able to tell you that answer, right, across that. So I think the mechanisms are in place, right, to educate these borrowers. But the question is, are they effective, or are they being or are these measures being conducted in the right manner so they are having the effect that they're intended to have? And I would argue no.
Excellent. Any other questions out there? Yes, sir, right here. I know you. Yes. Oh, I'm sorry, we have a woman here, and then, yes.
Who first? Me?
Yes.
Oh.
Yeah.
So quick question for Jessica. You all have years and years of research on homeownership, and which I think is a good indicator for the larger financial wellness picture. How do student loans measure up next to the other hurdles to homeownership or other major financial concerns based on what you've seen?
So I think this is really interesting. We only started collecting information on student loan debt recently, so within the last few years, because it wasn't that big of a problem. We weren't hearing that it was a big hurdle. And before the financial crisis, we steadily had around 40% of buyers were first-time home buyers, which is healthy because we want people to be able to move up and buyers for move-up homes. And so as that steadily dropped off after the first-time home buyer tax credit, that's also when student loan debts started to rise overall in the economy. And so that's when we started to ask about the problem. And we have seen a growth in the share of people who are recent buyers with student loan debt, especially among first-time home buyers, just in that short period of time.
Yes, sir.
Hi, I'm Bob Hilder from Inversant. I was just wondering if any of these quote-unquote unexpected industries have found a public voice around this issue. Have any of them started to lobby Congress or the states over the impact of student debt, be it on their retirement plans or or the housing sales?
On retirement, I'm not sure. I think that only in the last 2 or 3 years has there really been any research on the impact of student loans on retirement. So it's, if you look at the research, I think really starting in 2010, you start to see papers trying to connect student loans to issues related to retirement. So I haven't seen anyone lobbying from that angle yet. I'm not sure about the others.
On the home buying sector, with the research that we did with ASA, we were able to go to our board of directors in May, and they did pass essentially a description of what bills that they would support without listing the specific bills. So there's a number of actions that now NAR is behind and encouraging Congress to pass, hopefully, once the election season is finally over.
Right. Yes, ma'am.
Hi. I had a question. Earlier you mentioned that student loan debt is an intergenerational problem. So what's the effect on parents on borrowing in regards to retirement and housing? Are they like delaying retirement or that kind of thing? Question.
I think on the delaying retirement side, we actually do not know yet. On the savings piece, I think there's an impact, I guess, on two fronts. I think one, parents who take out loans pay off their house slower, and so they end up in retirement with that kind of debt a little more frequently. And then most of our research has looked at younger workers so far, but I think older workers with student debt are much less likely to be prepared for retirement. They're much less likely to be able to replace their pre-retirement income with retirement income. So I think there are consequences for older workers too.
And I would say it's going to be interesting because it's going to play out in the next couple of years, because I think this new kind of loan, which is the parental loans, is proving pretty popular, where originally the students are taking loans on their behalf, but now there's the new private parental loans that they can take on that. So it will be interesting to see how that affects the market, but there's definitely a direct correlation between retirement and parents taking a cost of education across that.
I think we can have one or two more questions.
Hello, my name is Julie Miller. I'm from the MIT Age Lab. I have a question for all three of the panelists, and you've been touching on this. I'm interested in what this conversation has to do with increased longevity as people are living longer. What do we need to think about with student loans?
I guess the big connection from our perspective is that because people are living longer and because we have retirement plans that aren't annuitized anymore, that they don't last forever necessarily, that people either need to work longer or they need to save more. And I think to the extent that we've heard that that student loan debt tends to do one of two things, either decrease savings or increase debt, which is really the same thing. You're going to have people hitting kind of the ages of 62, 63, 64 with not enough to maintain their standard of living for that long period of time. They now have to do it with a DC account. And so they either need to work longer, which is not possible for everybody, or they need to somehow, or that's it at that point. And so I think the shift to DCs combined with living longer means people need to save a lot more, and loans I think get in the way for parents especially, I think. But I'm not sure.
Good.
Well, I guess I'll answer that in relation to the last question as well as the generational linkage there. What we're seeing among recent home buyers too is that if you cut that data by generations, that there's a smaller share of older generations who have student loan debt, but they have larger amounts. So they're taking on that debt perhaps for themselves, or they've never paid off their own personal student loan debt, or they're taking on for their children. The other effect that I think will be important for home buying as well is that we're seeing a lot of first-time home buyers, much more than we've seen in the past. Actually, 21% this year moved from their parents' house or a relative's house into a home buying situation. So they never rented in between there. They could have rented, but they moved directly from their parents there. And I think that's going to have a long-term impact both on the parents, because they're not putting away as much for savings and not spending where they should to think about their own future, but that also impacts their children too.
Yeah, I would echo that. What I would say is this generation is facing really interesting, complex choices in terms of financial decisions, right? And there's not a lot of people who are guiding them through these financial decisions. So you look at somebody who's 35 to 55-year-old, all the rules of the games have changed within that for them, right? The rules of retirement have changed, the rules of healthcare have changed, the rules of education have changed. And the key question then becomes is, if you're saving, who should you be saving for? There's a lot of those people are supporting their parents who are living longer, right? So they're dealing with that issue. They are dealing with their own retirement. They're dealing with their own healthcare or saving for their own healthcare when they're older. And then they're also thinking about saving for the cost of education of their children in 529 plans and across that. So if you have an X amount of dollars to save, where do you allocate that? Or how do you save for all of these competing choices? And the rules of all these games have changed. So it's a really interesting time that we live in.
The other thing I would say about mortality that's interesting is there's rising, it's not just that people are living longer, there's rising inequality in mortality. So the people we're talking about here, which is college-educated people, are also living, they're living longer, but they're also living longer faster than average. So if the average male lives to be 85, the average college-educated male may live to be 90. And if that trend continues, then the very people we're talking about with loan debt are the people that are really going to live a very long time and need to think about having savings to make it that whole time. But
I saw one more question. Yes, sir. Oh, I'm sorry, ma'am. Then yes.
Hi, I'm Teresa Braun from Belvedere Investments, and I'm curious if, since income contingent repayment plans have the potential to increase the number of years that the loan is in repayment, especially from the real estate standpoint, any effect that this might have on, or if you've seen any effect on credit scores and how that correlation might relate to qualifying for a mortgage to begin with.
So this is actually the big reason why we started studying this issue, is because we were hearing from our members over and over again that they have borrowers, potential borrowers out there who can't actually qualify for a loan. And the reason is because their loan is negative amortization, as you had mentioned earlier. So that puts them in a situation where their credit score is absolutely affected and they would like to purchase a home. They may even have a down payment, but they're in the wrong loan program. And so we're hearing that, yeah.
Yes, sir.
I wonder if you can help us understand to what extent these impacts that are being seen in industry are attributable to borrowers who have debt without a degree versus those that have completed their degree work. 'Cause, I mean, I think there probably are some very important distinctions, but I wonder if you can help us explain how that might be quantified, or if there are some trends or directions that would be helpful.
on the retirement side, as I said, one of our studies, we did 2 studies. One of them looked at younger workers between 22 and 30 and their savings for retirement. The problem with non-degree holders in that study is that oftentimes they didn't have access to a retirement plan in the first place. So you don't, between people with loans and people without loans, you don't see a ton of difference for those without a degree in terms of how much they're saving for retirement. But the answer is none of them are saving much. On the parental side, we found that, on the older side, kind of post 30, we found that people who had loans but no degree were much more likely to be at risk of having a poor retirement than people who had loans and had a degree. In fact, people with loans and a degree looked very similar to people without loans. So for them, the degree was worth it. They got a good enough job that they were able to repay the loan, still save for retirement. They look okay. It's really the people without the degrees that look really bad later in life. So that's a great question.
I wanted to bring up something that we talked about a bit earlier, about the benefit, though, of having a college degree, even with this debt. I did a long-term series a while ago about for-profit colleges and the debt that many of those folks have, and I had one woman who told me she's telling her kids that college may not be where they should go, that they should go into a trade. And this was the first time that I had heard this message being told to a new generation. I'd like for you guys to talk a bit about that and your perspective on this, the importance of going to college despite this debt.
I think the point I just brought up is an important one for this question exactly, which is the people who were a little bit older and had a degree and student debt, they looked okay in terms of their retirement preparedness. And I think the reason is that they probably had good enough jobs, they were able to kind of deal with the debt fine. It was really the people without the degree that were affected. And I think in the grand scheme of life, I think student loan debt is something that can be overcome. It's a lot of money at a given point in time, but over the course of 30 years, if managed appropriately, it can work out well. It just, having a degree helps you do that a lot better, apparently, at least in terms of retirement savings. That's what we saw.
Well, the data is not ours. There's countless studies out there that are saying that those who don't complete a degree are absolutely the most at-risk population because you're not encouraged to, at that point, to actually pay off debt for something you didn't receive. So there's that also, that hurdle, besides not perhaps having the job that would be able to pay for that. I'm not going to discourage anyone from going to college. I do think absolutely it's a very smart and wise decision. But if you're not going to go to college, it's also smart to go and be trained for a trade, and that's something that also I would encourage people to do.
I mean, from our perspective, and we're not experts in these, but these are some of the things that we see. One is that it's not about having a college degree or not having a college degree, but also quantifying what you want to do in life, right? And what is the ROI of that stuff. So there's a great, there's some really interesting startups that are working on the cost affordability of college, or at least the biggest problem here is that just like in healthcare, there's no transparency in pricing a college education, right? So there's the sticker price, but then there's the net price. Every college is supposed to have a net price calculator. I don't know if you guys know that this or not, but every college is supposed to have a net price calculator. So what is the price transparency across that, and what are you getting from that college degree, and what do you want to do afterwards across that, right? So we have interviewed so many people who are like, I wanted to go work for a nonprofit and change the world, but now I have this crushing six-figure debt and I'm not being able to do that, right? And these are 18-year-olds who are taking these decisions of these things, and nobody's checking them for creditworthiness. They're not checking them for ability to pay. It's kind of like, hey, you're going to college. Here's a six-figure check for you. So it's not just about college or not college, but bringing price transparency and the ROI of that across that. So I think that's one. And also the second thing is, I think a lot of interesting startups or interesting organizations are thinking about alternative forms of education, right? Which is with technology, open courseware, other kinds of degree programs. Coding boot camps are getting really, really popular in the nation because they're like, hey, even after a four-year college degree, people are not prepared for the jobs of tomorrow, right? So I think there's going to be some interesting movement or shift in the next like five to 10 years about what is the worthiness of a college degree. That's the first thing. The second thing is around alternative cost avoidances or lower price things, and then also thinking about price transparency in this market.
We actually do have time for one or two more questions if there is one, and there's, yes, ma'am.
Thank you. In the housing or the retirement study, did you look at all or collect any data on debt to income ratio?
No, we really looked at different income categories, but I don't think we looked at completely debt to income ratio. So if they had other debts from other types of things. Among successful homebuyers, we do ask them to name the different types of debt that they have. And I will say among that, especially when you look at generations, Gen X is absolutely the most at risk, where we see that they still have student loan debt. They may have taken on graduate student loan debt. They end up with childcare costs and auto loans and credit card debt. So we do see them at the most at-risk population.
And Gen X is what age to what age?
Gen X is 36 to under baby boomers, so I'm not sure if the youngest baby boomer in the room wants to raise their hands. So.
Other questions? Well, I'd love, this audience will be spending the next day and a half. I'm sorry, did I cut you off from? No. Okay. This audience will be spending the next day and a half really looking at these issues and looking at ways that they can provide for relief for those student loan holders. I'd love to know, to get some last words from you guys on what you would love for them to consider based on your work as they tackle these really tough issues. And I'll start with you, Jeff.
I guess what I'd like you to consider is just the long-term consequences of this and thinking about ways to educate people on the right decision to make. Like, should they pay off the loan or save for retirement, or do both simultaneously? And if so, at what rate? I think those are really hard decisions to make for anybody, and for a 22-year-old. I think about my students, and they can't, they have trouble getting up in the morning. I think making these kind of decisions is hard for them, so educating them is really important, and so that'd be my important thing.
I will reiterate, education is very important, knowing what you're getting into, and perhaps being aware as you go through the process. As a junior, how much debt do you have? As a senior, how much debt do you have? I will say anecdotally, I have a little sister who lives in my basement, and she's probably never leaving anytime soon because we live in DC. And I can say her exit counseling was interesting in that I don't think she clicked through. So you're very excited at that point to graduate and go on senior week and go and get a job, which she did. But working in a DC nonprofit, it's going to be a road ahead to pay off her student loans. So I think knowing what that means when you click through that website very quickly.
Yeah, I would say a little bit of systematic thinking as a system, as opposed to individual point solutions, right? So there have been some articles which is like a student debt crisis, the next housing crisis. And if you look at the housing crisis, there was not one actor that caused it. It was everyone looking at their best interest, right, which is the rating agencies and the lenders, the borrowers who should not be borrowing that much amount across that as a system. And at some point, that whole system collapsed, right? So I think we're at a convening like this. I think it's a great venue for us to start thinking about not just point solutions, what we as employers can do or what we as lenders can do, but what we can collectively do together to address this problem as a group and as a system in American households.
Well, thank you, Akil, Jessica, and Jeff. This was a really great discussion, and thank you all for being here. And have a great next day and a half as you tackle this really important subject. Thank you.
Thank you very much.